Welcome, dear traders. Japanese authorities are committed to a flexible exchange rate which acts as a shock absorber and supports the monetary policy objective of price stability, the director of the IMF's Asia and Pacific Department said. The endorsement from the International Monetary Fund was a kind of a summary of the Bank of Japan's report released today. The document, titled "A Summary of Opinions," reveals the details of the regulator's January meeting. Despite the general ultra-soft tone, the report is characterized by some hawkish bias. In particular, the January meeting discussed the prospects of ending the negative rates policy and the transition to rate hikes for the first time since 2007. It was also pointed out that the conditions for such a decision were also improving. One of the meeting participants warned his colleagues that the regulator might miss a favorable moment of transition. However, when it comes to the current situation in the country's economy, the conditions are not yet favorable for changes in the monetary policy. The statistics for December confirmed the growth of industrial production and retail sales. However, according to forecast, these indicators grew less than expected. Thus, industrial production did not reach the market estimates of 2.4% and increased by only 1.8%. Retail sales in Japan rose by 2.1% year-on-year, compared with the forecast of twice as much, 4.7%. However, despite the small increase, December market the 22nd month that this indicator has risen in the strongest period of industrial growth. Economic growth increases the odds that the Bank of Japan will move to more aggressive interest rates in the long run. Meanwhile, moderate wage growth and cooling inflation are working in the opposite direction. As a result, the yen strengthened today, but then had to retreat under selling pressure to the 147.80 level. If the US dollar strengthens, the Japanese currency risks ending January with a decline of 4% or even 5%. However, the Japanese yen received some support from the narrowing of the interest rate differential between the United States and Japan. It also acts as a safe haven asset against the backdrop of escalating geopolitical conflict in the Middle East and economic problems in China. As a result, the yen's losses should be limited to the 147.10 and 147.90 range that has been in place for the past 2 weeks. However, the pair is still under the influence of the bearish trend. Therefore, a breach of the intermediate 147.30 and 147.00 level and the move towards the strong support at 146.60 is not out of the question. If the US dollar strengthens, the yen may fall lower and reach the resistance area of 148.20 and 148.80. As markets await the Federal Reserve's interest rate decision, the US dollar index posted its biggest monthly gain since September last year. Against its 6 major counterparts, the greenback has already gained 2% and was trading at 103.60 in Asia. At the start of the Asian session, the index showed growth in the 103.30 and 103.70 range. The main driver of the greenback surge continues to be the US economy's resilience against high interest rates. In addition, the number of job openings unexpectedly rose to 9.02 million in December, confirming the strength of the US labor market. These factors allow the US regulator to continue to take its time in moving towards a softer stance in monetary policy. Therefore, the US dollar strengthened across the board today. The most pronounced activity of buyers was observed in the Aussie dollar pair. As for the dollar's reaction to the upcoming events today, its price may move even higher to the resistance of 103.70 or even 104.20. The nearest support area for the greenback after the breach of 103 points is located at the 102.60 line. As expected, the US Federal Reserve will leave the interest rate unchanged at its meeting today. Another thing is about prospects for future reductions the Fed chief will outline in his comments. It's Jerome Powell's statement that will have a key impact on the US dollar exchange rate. As the FEDWATCH tool shows, less than 45% of the market now sees the probability of a Fed rate cut in March, and this compares to 73% earlier and over 80% in December last year. Now, according to Bloomberg, the odds of a March rate cut in the United States are about 1 to 3. In addition, hopes for increasing levels of policy easing through the end of 2024 are also fading. The Reserve Bank of Australia's outlook for interest rate cuts has been reduced to 2 cuts this year, and today reports showed that price levels in the country fell more than expected. Inflation in Australia fell to 4.1% in the fourth quarter of 2023, the lowest level in 2 years. As we mentioned earlier, the Australian dollar was the biggest loser against the US currency today. All of the factors that usually support the Aussie worked against it. In addition to the unexpected drop in the prices in the country, there were also weak indicators from the Chinese economy, as well as the drop in oil prices and the market's risk aversion ahead of the news from the United States. Therefore, the Aussie dollar pair dropped to the lower boundary of the intraday range of 0.6550 and 0.6600. The Aussie managed to recap some losses only at the beginning of the European session. And this is only temporary against the backdrop of some strengthening of the euro. After the release of data on employment in the private sector in the United States, the greenback can drag its Australian counterpart down toward the key support of 0.6550. If this support is breached, the pair may retest the monthly low of 0.6520. If the Aussie breaks the important psychological resistance of 0.66, it may enter the growth zone in the range of 0.6610 and 0.6620. The New Zealand currency was also under pressure in the last 3 days of January. Risk sentiment was overshadowed by cautious market participants ahead of the Federal Reserve's meeting and heightened tensions in the Middle East. As a result, the Kiwi was forced to snap its 2-day winning streak and retreated into a bearish range of 0.6100 and 0.6140 early Wednesday. In this context, there is a scenario for the New Zealand dollar to rise towards both the 0.6150 resistance level and the 0.6060 and 0.6020 support area. And that's all for now. Stay tuned for more updates with the InstaForex TV. We appreciate your feedback. Please leave your questions and comments below, and see you online soon.